Yes, students, now we will learn the last head of income, that is income from other sources. Section 56 to 59 of Income Tax Act contains the provisions with respect to income from other sources. 56 being a charging section specifies any income which is taxable under the income tax law but not covered under the first four heads will be taxable under this head. We also call this head as residuary head, guys. And section 56 subsection 2 lists down few items or few incomes which are specifically taxable under the head income from other sources. But these items are not the end list. In addition to this, can there be any other income which is taxable under the head income from other sources? Yes. So we have already learned what incomes are taxable under the first four head, that is salary, house property, PGBP and capital gains. So anything which is not taxable there will be covered here, guys, and including clubbing provisions. So for clubbing, I have given a note here. You see, whenever someone else income is clubbed with me, for example, if my spouse income is clubbed with me or if my minor children's income is clubbed with me, it will always be clubbed under the head income from other sources, irrespective of the nature of the income earned by the person. For example, assume my spouse income is clubbed with me. Irrespective of what nature of income is it is for her, doesn't matter. First, we will compute the income in her hands and it will be clubbed with me under the head income from other sources. And we will learn in detail about the clubbing in the next chapter, guys. Okay. Then coming back to this, Section 56(2), as I told you, lists down few incomes which are specifically taxable under the head income from other sources. So what are those? One by one we will see, guys. First one, dividends. Dividend income is always taxable at a normal rate in the hands of shareholder under the head income from other sources, including deemed dividend. Sir, what is deemed dividend is covered in section 2 clause 22, guys. So what is it? I have given it after a few pages. Come to this point, guys. We will cover it. Yes. Now, see, dividends, which is normally paid by the company to the shareholder, whether it is equity or preference, it will be paid in the form of final dividend or interim dividend. This is a regular dividend which any company will pay to the shareholder. It is always taxable in the hands of shareholder at normal rate of tax, guys. Okay, it is the normal income taxable at normal rate. But sometimes what company do is they will try to give the benefit to the shareholder, but not in the form of money, but in kind. They may give the assets of the company. They may give bonus shares to the preference shareholders like that. So in such case, whatever is the value of the benefit which the company is trying to pass on to the shareholder will be considered to be the deemed dividend in the hands of shareholder to the extent of accumulated profit held by the company. And here accumulated profit, it is nothing but reserves and surplus, guys. When company have the money in the form of reserves and surplus, they can use that only to pay dividend. But instead of that, they're trying to give the benefit to the shareholders in some other form. So that is why it is taxed in the hands of the shareholder as deemed dividend as per section 2 clause 22. And here please be careful, the amount which is taxable in the hands of the shareholder is only to the extent of accumulated profit. Accumulated profit is nothing but the reserves and surplus in the hands of company, guys. Okay, let me just try to give an example here. Assume the company is distributing an asset to the shareholder whose value is 10 lakh, but they have accumulated profit of 4 lakh. So 10 lakh or 4 lakh, whichever is lower, 4 lakh will be taxable in the hands of shareholder under the head other sources, guys. Now, another example. Now, assume the company is distributing or giving any other asset to the shareholder, or maybe the bonus shares to the preference shareholder, or maybe debentures to the equity shareholders. We need to check what is the value of that shares or debentures and compare that with accumulated profit. Assume the value of debenture given to the equity shareholder is 5 lakh, whereas the company has an accumulated profit of 15 lakh. Now, how much will be taxable in the hands of the shareholder, guys? Only 5 lakh. Clear? So simple. The value of the benefit which the company is giving to the shareholder or the amount of accumulated profit, whichever is lower. Sir, what if company doesn't have any accumulated profit? Then nothing will be taxable in the hands of the shareholder as deemed dividend, guys. Okay. So what all is covered under deemed dividend definition we will see, and it is arranged in the sub clauses, guys. Section 2 clause 22 defines deemed dividend. Okay. Yes. Now, it has various subclauses. What are those? One by one, we will see. First one, any distribution of assets of a company to its shareholder. And here the company is not going into liquidation. They are continuing with the show. During the continuation of the show, that is the company is a going concern and they are distributing the asset to the shareholders. So whatever is the market value of that asset will be taxable in the hands of the shareholder as deemed dividend, but subject to or limited to or restricted to accumulated profit. Okay, yes, sir. Then B, any distribution of debentures, debenture stock, or debenture certificate in any form, whether with or without interest, to the equity shareholders. So if company is distributing or giving debenture or debenture stock or debenture certificate to the equity shareholders, the value of that will be taxable in the hands of equity shareholders. Same way, if there is any bonus shares issued to the preference shareholder, then it will be taxable. Whatever is the value of that bonus shares will be taxable in the hands of the preference shareholders. But the company can issue bonus shares to the equity shareholders. That is allowed. In that case, it will not be taxable in the hands of equity shareholders. But if they give bonus shares to the preference shareholders, it is taxable, it seems. Okay, sir. Fine. Then clause C. Clause C. Any distribution made to the shareholders of the company on its liquidation. Okay. First point was they didn't mention anything about liquidation. That means during the continuation of a company, they are giving the assets to the shareholder. Whereas now it is clearly telling it is on liquidation. So if company is going into a liquidation and if they are distributing any asset or money to the shareholder, then to the extent of accumulated profit, it will be taxable and in the hands of shareholder as deemed dividend. If you remember, I had covered this point along with capital gains topic. That is, when company is going into liquidation, if they distribute any asset or money to the shareholder, to the extent of accumulated profit, it will be taxable in the hands of shareholder as income from other sources. Remaining value or remaining amount will be considered to compute capital gains income as full value of sale consideration. Just a minute, I will just show you. Yes. So you can see here, when a company give money or the asset to the shareholder at the time of liquidation, then the fair market value of the asset or the money received will be the full value of sale consideration in the hands of the shareholder to compute capital gains income. But to the extent of accumulated profit, we will reduce it because it is taxable under the head income from other sources. This is what we are learning now, guys. Clear? I had also explained it with a numerical example. Assume the value of the asset distributed by the company to the shareholder at the time of liquidation is 10 lakh, whereas the company had an accumulated profit of 2 lakh. So how much will be the full value of sales consideration to compute capital gains income? 8 lakh. And this 2 lakh will be taxable under the head income from other sources, guys. Okay, sir. Then Then, if any amount is distributed by the company to the shareholder after the liquidation, then it will not be considered as deemed dividend, guys. It will be considered as repayment towards capital after liquidation. Okay. That means what is covered here is at the time of liquidation. After liquidation, if anything is distributed, then it is a repayment towards the capital and it will not be taxable as deemed dividend. Okay. Then coming to clause D, subclause D, any distribution to the shareholder by the company on the reduction of capital of a company. Now company had assumed 100 crore capital. Now they want to reduce it. So they are distributing the money to the shareholder. That amount will be taxable in the hands of shareholder as deemed dividend. And the last one is with respect to loan and advance. So please pay attention, guys. Here a lot of connections are there. Any payment in the form of loan or advance to the extent of accumulated profits excluding capitalized profit. Okay. See, for the first four cases, we need to take total accumulated profit. Whereas last case, that is E, we need to take only revenue reserves. We should not take capitalized profit, guys. Okay. Made by a closely held company. Closely held company means private limited company, guys. That is a company in which public are not substantially interested. Okay. So, what are the things are covered in three scenarios here? This loan or advance is given by a private limited company to whom? To its shareholder, who is the beneficial owner of the shares, holding not less than 10% of voting power in such company. That is equity shares. Okay, this is direct. Next, indirect also is covered. to any concern, that is HO, firm, AOP or BOI or a company in which such shareholder, means this shareholder, is a member or a partner and in which he has a substantial interest, that is 20% or more of voting power or share of profit. Okay. Then the last one. Any person on behalf of such shareholder for his or her individual benefit. Okay. I will try to explain this with an example, guys. Yes. So pay attention now. Now assume Mr. A is a shareholder of A Limited and he owns more than 10% of equity shares in a company which has voting right. Okay, sir. Now A Limited is giving a loan or advance of 5 lakh rupees to Mr. A. Is it a deemed dividend in the hands of Mr. A? Yes. 5 lakh is taxable as deemed dividend in the hands of Mr. A. This is the first point. Next, coming to second point. Now, Mr. A has more than 10% equity shares in A Limited and he has more than 20% equity share in any concern or more than 20% of share of profit in any HUF or a partnership firm. And now A Limited is not giving loan to Mr. A directly. They are giving it to a concern in which Mr. A has a substantial interest. In that case, whatever loan or advance A Limited is giving to a concern in which Mr. A has a substantial interest, no, it will be taxable in the hands of Mr. A as deemed dividend, guys. Okay, sir. Then the last one. This is done. This is done. The last one. Now assume A Limited is giving a loan or advance to any relative of Mr. A or any third person, but for the benefit of Mr. A. In that case, whatever loan or advance A Limited is giving to this third person or a relative of Mr. A, but for the benefit of A, will be taxable as deemed dividend in the hands of Mr. A, guys. Got it? So all the 3 points I have explained. But if A Limited business itself is giving loan or advance in the ordinary course of business, then this provision will not be applicable. If giving loan or advance is the business of a company, then this provision will not be applicable, guys. Means there won't be any deemed dividend taxable in the hands of shareholder. Okay. Then F. F is with respect to buyback of securities. If you remember, I had covered this in capital gains head itself, guys. When a domestic company buy back the shares from the shareholder, whether it is listed or unlisted, whatever is the buyback price paid by a domestic company to the shareholder, it will be taxable in the hands of the shareholder as income from other sources, that is deemed dividend. And you cannot claim any expenses against it, not even the cost of acquisition of shares. But cost of acquisition of shares will be allowed as capital loss under the head capital gains, guys. But this is only when the shares are bought back by domestic company. If it is bought back by any other company, then capital gains income will be calculated in the hands of shareholders, guys. Okay, sir. So this is all about deemed dividend, guys. Now coming back to this point. Okay, coming back to this. Come back to this. Yes. Okay. So dividend income is always taxable under the head income from other sources. But if assessee has incurred any interest expenditure to earn dividend income, like assume I have taken a loan in order to invest in the shares and I am earning dividend income from the investment in shares, whereas I am paying interest for my loan. Now, whatever interest I am paying, can I claim it as an expenditure against the dividend income? Yes, but maximum 20% of such income. Maximum interest expenditure which I can claim against dividend income is 20% of such income, guys. Okay, sir. And I cannot claim any other expenditure against dividend income. But if there is a buyback of shares by a domestic company and if the dividend income is taxable in the hands of shareholder, that is nothing but buyback price, against that no expenditure can be claimed. Even interest expenditure cannot be claimed against it, guys. So whatever we learned under section 222F, when there is a buyback of shares by a domestic company, against that no expenditure can be claimed. If there is any other dividend income, we can claim only interest expenditure, but maximum 20% of such dividend income. Okay. So I will try to explain this with an example. You can look here. Now assume an assessee has earned a dividend income of 1 lakh And to earn this dividend income of 1 lakh, he has incurred an interest expenditure of 30,000. Now, how much expenditure he can claim, or how much interest can he claim it as expenditure? So, actual interest expense is 30,000, or 1 lakh into 20%. That is dividend income into 20%, which is 20,000. Whichever is lower, 20,000. So, from 1 lakh, we will claim 20,000, remaining 80,000 is taxable as income from other sources. Then, one more example. Dividend income is 1 lakh. Okay. Interest expenditure incurred to earn the dividend income is 15,000. So how much expenditure can we claim? Actual interest expenses 15,000, or 1 lakh, that is dividend income into 20%, which is 20,000. Whichever is lower, 15,000. Okay. So claim it against the dividend income. Remaining 85,000 will be taxable as income from other sources. Okay, sir. Even for buyback, I will just give an example. Assume, guys, Infosys Limited, which is a domestic company, want to buy back the shares from Vikas. Vikas was a shareholder in Infosys company who had purchased the shares for 1 lakh rupees. Okay. Now, Infosys company wants to buy back the shares from Vikas and they are ready to pay 3 lakh rupees for this, which is called buyback price. Okay. So, entire 3 lakh will be taxable in the hands of Vikas in the year of buyback as what? Deemed dividend under the head income from other sources. Sir, what about this 1 lakh rupees cost of acquisition? This will be allowed as capital loss. That is either short term or long term, depending upon the period of holding. Vikas can claim this 1 lakh as capital loss and adjust it against. If it is a short term loss, he can adjust it against either short term gain or long term gain. Or if it is a long term loss, he can adjust it only against long term gain, guys. Got it? Yes. And against this 3 lakh, can he claim any expenses? No. Vikas cannot claim any expenses against 3 lakh, guys. Then coming to the second point, amount received under a keyman insurance policy, including bonus, if it is not taxable under other rates. Sir, when is it taxable year is? When it is received by legal heir or nominee, guys. See, when keyman insurance policy matures, we need to see who is receiving the policy amount. If the amount is received by employee, it is taxable in the hands of employee under the salary head. If the amount is received by employer, then it will be taxable in the hands of employer under the head PGBP. And the last scenario, if it is received by a nominee or legal heir of an employee who has died, in that case, it will be taxable in the hands of the person who received it under the head income from other sources. And for keyman insurance policy, there is no exemption available under section 1010D, guys. Okay. Then the third ones. Any winnings from lotteries, crossword puzzles, races, including horse race, card games, and other games of any sort, or from gambling or betting of any form or nature. In simple, we call it as casual income. It is taxable under the head income from other sources, and the tax rate applicable for this is flat 30%, guys. And assessee cannot claim any expenses against casual income, and he cannot even adjust any loss against casual income. He cannot claim any chapter 6A deductions against casual income, and he cannot even adjust basic exemption limit against casual income. For example, assume I have a winnings of 5 lakh. Straight away 5 lakh is taxable at 30%. Straight away 5 lakh is taxable at 30%. Sir, I am an individual, slab rate is applicable for me. No, 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 sorry. Against casual income, you cannot even adjust basic exemption limit. And in capital gains head, we learned if normal income is less than basic exemption limit, then we will have something called a shortfall or unexhausted basic exemption limit, which we can adjust it against capital gain special income. Sir, can we do that against casual income? No, not possible. Not possible, guys. Okay, then fourth one. If the assessee is letting out any machinery, plant, or furniture, and if he is earning rental income, it will be taxable under the head income from other sources, provided he is not in the business of letting out. If the assessee business itself is letting out of machinery, plant, or furniture, then the rental income will be taxable under the head PGBP, guys. Okay. Next, interest on security or any other interest income will be taxable under the head income from other sources. Now, if interest on securities or earning interest is in the course of business for the associate, then it will be taxable under the head PGBP. Like for financial institution, bank and all, earning interest itself is their business. So in that case, interest will be taxable for them under the head other sources. Whereas for us, investors and all, if we earn any interest on securities or bonds or interest on our any deposits like saving deposits, FD or post office deposit, Where is it taxable for us? Income from other sources, guys. Okay. Next, income from letting out of machinery, plant or furniture or building, which is inseparable. If assessee is letting out building along with other assets, where single amount of rent is charged, that is composite rent, which cannot be bifurcated between building and other assets, then the entire rental income will be taxable under the head income from other sources if letting out is not a business of assessee. If letting out is the business of an assessee, then such rental income will be taxable under the head PGBP. Got it? Yes. Sir, what if it can be bifurcated? For example, assessee can tell what is the rental income for building and what is the rental income for other assets. Then income from building, rental income from building will be taxable under the head house property, whereas rental income from machinery, plant and other assets will be either taxable under the head PGBP if letting out is the business of an assessee. If not, it will be taxable under the head other sources tax. Okay, sir. Then if there is a compulsory acquisition and if any compensation is paid to the assessee, then that compensation will be considered as full value of sale consideration to compute capital gains income. But if there is a delay in payment of this compensation, assessee will also be receiving interest. So interest on compensation or enhanced compensation will be taxable in the hands of assessee in the year in which it is received under the head other sources. But 50% flat deduction will be provided and no other expenditure can be claimed as. For example, assume I received interest on compensation 5 lakh rupees. Only 2 lakh 50,000 will be taxable and no other expenditure can be claimed against it. Sometimes in the question they may give like legal expenses, court fee and all. But please don't claim such expenses. Whatever is received, 50% of that will be straight away taxable, guys. Okay. Then, and it will be taxable on receipt basis. That is the year in which it is received, irrespective of when it was accrued. Then, if there is any advance money received and forfeited, where the transfer didn't take place, and if it is received on or after 1st April 2014, it will be taxable under the head income from other sources in the year in which it is received and forfeited, guys. Okay. This point also I had already covered it under capital gains head. Then coming to family pension. Guys, if after retirement, if employee is alive and if employee himself is receiving the pension, then that pension will be taxable in his hands under the head salary. And if he commute and receive the lump sum amount, he can claim some exemption, which we already learned in salary head. Okay. Now, sir, what if employee has died and their family members are receiving the family pension? In that case, the family member, whoever is receiving the family pension, it will be taxable for them under the head income from other sources. Income from other sources. Okay. And that family member who is paying tax on the family pension can claim some deduction. What is it? It is eligible for a standard deduction, which is 1/3 of such pension or 15,000 per annum, whichever is lower. 1/3 of the pension received or 15,000, whichever is lower. And if that family member is following the default scheme under section 115 BAC, instead of 15,000, it is 25,000. That is, assume the family member is receiving the family pension and how much deduction they can claim if they are following default scheme is 1/3 of such pension received or 25,000 per annum, whichever is lower. Whichever is lower, guys. Yes. Next. Last one, yeah. Some received, including bonus under a life insurance policy other than ULIP and keyman insurance policy. Keyman insurance policy will always be taxable, okay, which is not exempt under section 1010D. Okay, any amount received at the time of maturity of the policy for which exemption under section 1010D is not available is taxable under the head income from other sources. But this provision is not applicable for ULIP and keyman insurance policy. And keyman insurance policy will always be taxable, guys. Whereas for ULIP, if the yearly premium is more than 2,50,000, then when policy matures, exemption under section 1010D is not available and ULIP will be treated as what? Capital asset. And it is included in the capital asset definition, which is given in section 2 clause 14. Hope you guys remember it. Oh, so I have given an explanation for it. But before that, I will just try to explain the provisions with respect to this through chart. Just a minute. Yeah. When life insurance policy matures, okay, whatever provision we are discussing, it is for policy other than ULIP and keyman insurance policy, guys. Okay, I repeat, for keyman insurance policy, when it matures, always it is taxable. In whose hands and under which head, we already seen. It can be taxable in the hands of employer, employee, or family member, whoever is receiving it under the respective head. Okay. And if it is a ULIP, we need to see when this policy was taken and what is the yearly premium paid. And if the yearly premium is more than 2,50,000, then ULIP will be considered as capital asset. And when it matures, we need to compute capital gains income. Okay. So whatever provisions we are learning is for any life insurance policy other than this two. Okay. So if life insurance policy mature on the death of the insured, insured means the person in whose name the policy is taken. So the insured has gone forever. Oh, bita, complete a bita. Okay. In that case, it is fully exempt under section 1010D. The family members or the nominee, whoever is receiving the amount, full amount, they will claim exemption under section 1010D and nothing will be taxable. Okay. Sir, what? At the end of the term of the policy, still the insured is alive and he is the one who is receiving the money. And you know, life insurance policy will mature on earlier of the death of the insured or the expiry of the term. Expiry of the term means, assume I have taken the policy for 10 years. So at the end of 10 years, if I'm still alive, will I get the policy amount? Yes. Okay. So if the policy is maturing on the expiry of the term, in that case, we need to see some conditions. If the yearly premium of sum assured is nothing but like policy amount. So assume I have taken a policy for 50 lakh, that is called sum assured. Okay. So if the yearly premium in every year it should be within a limit, guys. Okay. So in every year, if the amount of premium which is paid is within 10% or 15% or 20% of sum assured, and if the policy is taken on or after 1st April 2023, then there is a monetary limit also. The yearly premium should be less than or equal to 5 lakh. If these conditions are satisfied, when the policy mature, the assessee claim exemption under section 1010D and nothing is taxable. Sir, what if in any 1 year, the premium whatever is paid is more than this percentage, that is 10, 15 or 20%, or at least in 1 year the premium paid is more than 5 lakhs, sir. And this 5 lakh is applicable only for the policies which is taken on or after 1st April 2023, guys. Whereas if it is taken before that, we need to check only the percentage. Okay. So in that case, even in 1 year, if the premium paid is more than a specified percentage, then exemption under section 1010D will not be available. So policy amount will be taxable in the hands of the insured who is receiving it under the head income from other sources, guys. And during the term of the policy, whatever premium is paid on the life insurance policy is allowed as deduction under section 80C in the year in which it is paid. Okay. That is for the premium paid. Okay. Then, sir, here you are given 3 percentage, 10, 15, 20. When, what percentage, sir? It depends on the date of issue of the life insurance policy, guys, which we will see now. Hope you guys understood. You can just have a look into it. If it is received on the death of the insured, we will never check any condition. It is completely exempt in the hands of a nominee who received it, guys. We check these conditions only when policy matures on the expiry of the term, that is the time period. Okay. And this 5 lakh limit will come only if the policy is taken on or after 1st April 2023. And if the policy is taken on or after 1st April 2023, we need to check both percentage as well as monetary limit. Both we need to check. Got it? Yes, sir. Fine. I will go back to this. So we will see when exemption under section 1010D is not available. Sum received under a life insurance policy is only exempt other than the following. Means the following is taxable. So when is it? Sum received under section 80DD subsection 3. That is when assessee is taking care of a dependent who is suffering from disability, and if a policy is taken in that dependent name and if that person dies, the assessee will receive the sum assured. No? Is it exempt in his hands? No. Because when dependent was alive who was suffering from disability, assessee would have claimed a flat deduction under section 80DD. So if the dependent dies, whatever policy amount which the assessee will receive, it will be taxable, guys. No exemption is available under section 1010D. Got it? Yes. Next, sum received under a key man insurance policy. Okay. Then this is important. Premium payable for any year for policy issued on or after 1st April 2003 but before 31st March 2012. What is the maximum percentage you can pay? 20, more than 20% of the sum assured. If it is less than or equal to 20%, exemption is available. Even in 1 year, if you have paid more than 20% of the sum assured, then exemption is not available. Okay. So this is for the policy issued in between this date. Sir, what if the policy is issued on or after 1st April 2012? Then instead of 20%, it is 10%. If it is more than 10%, even in 1 year, exemption is not available. Okay, sir. Then on or after, if the policy is issued on or after 1st April 2013, and if the policy is for a person who is covered under section 80DDB, who is suffering from specified disease, or 80U, that is when assessee himself is a disabled, then instead of 10%, for normal people it is 10%, whereas for this people, they are giving a higher limit of 15%. If the premium paid is more than 15% of the sum assured, then exemption will not be available, guys. And please be careful, 80U is when assessee himself is disabled, whereas 80DD is when there is a person who is dependent on the assessee who is suffering from disability. Assume my brother. Got it? Yes. And what is the exact difference between this? I will explain in deductions chapter, guys. Okay, fine. So this is the percentage limit. Whereas for the policy which is taken on or after 1st April 2023, along with this, there is also a monetary limit. If the aggregate amount of premium payable is more than 5 lakh for any year during the term of such policy, exemption will not be available, guys. So please be careful. In the following case, exemption is not available. That means if the premium paid in every year, if it is within this limits, is exemption available? Yes, exemption is available. Okay. However, the above percentage limit or monetary limit is not applicable if the policy matures on the death of the insured. In that case, it is fully exempt, guys, as I have given here. So percentage limit as well as monetary limit is only when policy mature on the expiry of the term, guys. That is time period. Okay, sir. Fine. And I have also given a note. Whatever premium is paid on the life insurance policy can be claimed as deduction under section 80C during the term of the policy. That is during the tenure of the policy every year. Whatever premium the assessee is paying on the life insurance policy, he can claim deduction under section 80C. But maximum deduction under section 80C is 1,50,000. And that too, it is available only for the assessee who is following optional scheme now. Oh, fine, guys. Chalo, I have given few illustration on this. We'll quickly go through. Now, so illustration 1. Everywhere I have taken the date of policy on or after 1st April 2023, guys. Clear? So that we can discuss both percentage as well as monetary limit. Clear? Sir, what if the policy is taken before this? Then we need to check only percentage. Monetary limit is not required. Whether it is less than 5 lakh or more than 5 lakh doesn't matter. Okay, fine. So policy date is on or after 1st April 2023. So assessee has taken three policy X, Y and Z. Okay. So sum assured is 30 lakh, 40 lakh and 60 lakh. And premium paid, yearly premium is 4 lakh, 4 lakh 50, 6 lakh. So you can check first individually, check the percentage. Whatever percentage is given, no, 10, 15, 20%, it is for each individual policy, guys. Okay. So here you can check 4 lakh divided by 30 lakh. So the premium paid is more than 10%. So exemption is not available. Okay, sir. Then 4,50,000 divided by 40 lakh. Again, the premium is more than 10%. Clear? Because this is a policy issued on or after 1st April 2023. No. So what is the percentage limit? 10%. And even if by chance, if date of policy is not given in the question, guys, you consider 10%. If in case if they are not given. Okay. Fine. So here also exemption is not available. Last case, it is 6 lakh. Actually, if you check, it is exactly 10%. So percentage wise, okay. But amount wise, you see more than 5 lakh. More than 5 lakh. So this term is violated. So even in that case, exemption is not available, guys. Okay. Both we need to check. Then coming to illustration 2. So there are again three policies whose sum assured is 50 lakh, 40 lakh and 60 lakh. Premium paid also is given. Let us see one by one. First one, 4 lakh divided by 50 lakh. It is within 10%. And even if I check monetary limit, it is within 5 lakh. Can assessee claim exemption for it? Yes, he can claim it. Okay. Then coming to policy Y. Check percentage wise. 3,50,000 divided by 40 lakh. It is within 10%. And if you check individually, the monetary limit is within 5 lakh. But is exemption available? No, because I need to check aggregate. If I check aggregate, it is 7.5 lakh, which is more than 5 lakhs. So can assessee claim exemption for the second policy? No. He can either claim for X, he can claim for Y. So if you ask me, sir, which is more beneficial? Obviously Y. Sorry, obviously X. Why so? Because the policy amount is more here. The policy amount is more here, guys. Is that clear? Yes. So either the assessee can claim exemption for policy X or policy Y. So if choice is given to him or given to you, which one will you choose? X or Y? Wherever the benefit is maximum, right? So go for X. Clear. But can he claim for both X as well as Y? No, no, no. Because aggregate will be more than 5 lakh. Got it? Yes. Whereas for policy Z, the yearly premium is more than 5 lakh straight away for a single policy. So no exemption. No exemption, guys. Okay. Then illustration 3. There are 3 policy again. Sum assured is 30 lakh, 30 lakh, 20 lakh. And the premium paid is 2 lakh, 2 lakh, 2 lakh. Okay. Now percentage wise you check. Here it is less than 10%, whereas here it is exactly 10%. So percentage wise, no problem. Monetary wise, you check 5 lakh. So here it is within 5 lakh. Okay, exemption is available. Here also it is within 5 lakh, but check aggregate. If you do aggregate, you will get 4 lakh, which is again within 5 lakh. So can assessee claim exemption for both the policies? Yes, he can claim. Sir, can he claim for Z also? No, because if you add up all three, you will get 6 lakh, which is more than 5 lakh. So in aggregate, if it is more than 5 lakh, then the last policy he cannot claim. He can claim exemption for any 2 policies. So he has to choose where the benefit is maximum. Now he can either choose X with Y or X with Z or Y with Z like that. But here the sum assured is only 20 lakh. So go wherever the benefit is maximum, guys. So it would be beneficial for an assessee to claim exemption for policy X and Y. Even the percentage wise it is lower within 10%, as well as the aggregate premium paid both the policies put together is within 5 lakh. Okay, the last one, sum assured 70 lakh, 80 lakh, 60 lakh, and premium paid is 7 lakh, 6 lakh, 50 and 6 lakh. See guys, percentage wise no problem. 7 lakh divided by 70 lakh, exactly 10% also no problem. Here also no problem. Here also no problem. But amount wise you see, it is more than 5 lakh. For each policy, the yearly premium is more than 5 lakh. So exemption is not available, guys. Exemption is not available. Okay, sir. Fine. Then, okay, sir. So we learned when exemption in the section 1010D is not available. So if exemption is not available, that means it is taxable. Yes. Where under the head income from other sources? Yes. But how much? How much is that? So sum received under the life insurance policy on the expiry of the term, including bonus you take. And from that we need to deduct what is the total amount of premium paid during the term of the policy you take. And from that you need to deduct deduction claimed under section 80C during the term of the policy by the assessee. Okay, let me just explain this with a number, guys. Assume the sum assured is 50 lakh. And for this, the assessee has totally paid a premium of 40 lakh throughout the term of the policy. And for this 40 lakh entire exemption, he cannot claim because ATC has some limits. Okay, assume he could claim only 15 lakh deduction under section ATC. So remaining is how much? 25 lakh. So deduct 25 lakh from 50 lakh. Remaining 25 lakh will be taxable under the head income from other sources, guys. Got it? Yes. So take the total policy amount including bonus, and in the inner column, take the total premium paid. From that deduct what is the ATC deduction claimed for premium. Remaining amount, take it to the outer column, reduce it from the policy amount. Remaining would be taxable under the head income from other sources, guys. Hope you got it. In detail explanation I have given for this. Okay, let us move on. 10th one done. Next, the most important section under the head income from other sources, that is gift taxation, guys, which is covered in section 56 to 10. Before I start with this, guys, let me clarify. If assessee is receiving gift from his employer, then that gift will be taxable under the head is salary. This is the gift which is received from anyone else other than employer. Other than employer. Okay, sir. And here the gift can be in three forms: money, movable property, and immobile property. Immobile property means land, building, or both. Whereas movable property, all movable properties are not covered here, only specific movable property. Which are those? I have just mentioned here in the bracket. Let me read out. Shares and securities, jewelry, archaeological collections, drawings, paintings, work of art, sculptures, or bullion, guys. Sir, what if it is any other movable asset is given as a gift? For example, assume I received car as a gift, bike as a gift. Is it taxable? No, sorry, it is not taxable. Got it? Yes. And what value will be taxable? I will try to explain with a chart, guys. Just a minute. Okay. And this charts is not a part of the revision material. If you want, you can just pause the video and make a note of it, guys, once I'm done with the explanation. Yes. First, if the gift is received in the form of money, check what is the aggregate value of money received during the year as a gift. If it is less than or equal to 50,000, not taxable. If it is more than 50,000, then the entire amount will be taxable, guys. That is aggregate value of money received. Okay, and please be careful, it is aggregate value of money. For example, assume 5 of you gifted me 20,000 each. What is the total value of the gift which I received? 1 lakh. Is it more than 50,000? Yes, entire 1 lakh will be taxable for me. Clear? So, per assessee, we need to calculate the aggregate amount, guys, per annum. Okay. Then, if it is a specified movable property, why I have mentioned specified movable property? Because all movable properties are not covered, guys. What are those which are covered here? I already discussed. We already learned it. Okay. So, if any specified movable property is received without consideration, that is as a pure gift, check what is the fair market value of that movable property on the date on which it is received. If fair market value is less than or equal to 50,000, it is not taxable. If it is more than 50,000, then entire fair market value will be taxable in the hands of the receiver under the head income from other sources, guys. Okay. Then, sir, what if the movable property is purchased but for an inadequate consideration? But for an inadequate consideration means for a lower value. So, the difference between the fair market value and purchase consideration, we call it as IC. IC means inadequate consideration. First, find out what is the inadequate consideration. If inadequate consideration is more than 50,000, then inadequate consideration will be taxable in the hands of the purchaser under the head other sources, guys. Sir, what if inadequate consideration is less than or equal to 50,000? Not taxable. Got it? Yes. How do we calculate inadequate consideration? I am repeating again. Fair market value minus actual purchase price. Okay, sir. This is with respect to movable property. Yes. With respect to immobile property, important. Please pay attention. Yes. Immobile property includes land, building, or both, guys. So if it is received without consideration, that is as a pure gift, check what is the stamp duty value of that land, building, or both on the date on which it is received. If by chance, if date of agreement and date of registration is different, we need to take stamp duty value on the date of agreement if at least a part of the consideration is paid in any mode other than cash. Sir, in any mode other than cash means in what mode can we make the payment? Rule 6ABBA, which we discussed at the end of PGBP head, guys, which prescribed various modes. Okay. So if stamp duty value is less than or equal to 50,000, then it is not taxable. But if stamp duty value is more than 50,000, then entire stamp duty value will be taxable in the hands of the receiver under the head income from other sources, guys. Okay, sir. Then with consideration means I have purchased land or building, but for a lower value. But for a lower value. In that case, first we need to calculate inadequate consideration. What is the amount of inadequate consideration? So how do we calculate? It is the difference between stamp duty value and purchase price. Stamp duty value and purchase price. Okay. So if inadequate consideration is more than IR of A or B, IR of A or B, what is A? 50,000 standard amount. B is 10% of purchase price. 10% of purchase price. So take A and B, whichever is higher. And if inadequate consideration is more than this figure, then inadequate consideration will be taxable in the hands of purchaser, guys. That is buyer. Okay. Sir, what if it is? What if inadequate consideration is less than or equal to that figure? Then nothing would be taxable in the hands of buyer. This especially is important, and this is where normally students get confused. So I will also try to explain with a numerical example, guys. Yeah. And before that, I will just show you this. Yes. This is for money and movable property, and this is for immobile property. Yes, sir. Fine. Now, for immobile property, I'm just trying to explain with an example, guys. Okay. Now, assume I have purchased a land or building for 50 lakh, whose stamp duty value on the date of purchase is 54 lakh. First possibility. So, first find out what is inadequate consideration. 54 lakh minus 50 lakh, it is 4 lakh. Okay, sir. So, compare 4 lakh with higher of the two things. That is 50,000 standard amount or 10% of actual purchase price. So, 50 lakh into 10% comes to 5 lakh. So, whichever is higher, 5 lakh, and 4 lakh is less than 5 lakh. So that means nothing is taxable in the hands of buyer. Okay. Same way. Now let us assume stamp duty value is 60 lakh. Okay. So what is the inadequate consideration? 60 lakh minus 50 lakh, it is 10 lakh. Compare that with higher of two figures, that is 50,000 or 10% of actual purchase price, which is 5 lakh. Whichever is higher, 5 lakh. So inadequate consideration is more than 5 lakh. That means the taxable amount is inadequate consideration in the hands of buyer. Is that clear? Yes. And I have given here one connection from buyer point of view as well as seller point of view. If there is a sale of land or building or both, from seller point of view, we need to check two areas. If it is a capital asset to the seller, then I need to check section 50C and compare the actual sale value with what? Stamp duty value. Same way. If seller, if land or building is a stock or inventory, then I need to check section 43CA and compare the actual sale value with what? Stamp duty value. Clear? And if stamp duty value is more than 110% of actual sale value, we need to take stamp duty value as a sale value to compute either capital gains income year or year business income, which I already discussed under the head capital gains, guys. Whereas now what we are discussing from buyer point of view, for whom land or building is a capital asset. Guys, gift taxation under section 56 to 10 is applicable only when for the recipient it is a capital asset. Okay. So we need to check section 56 to 10 where we need to compare the stamp duty value with actual purchase price. And if the difference is up to 10%, they are okay with it. But if it is more than 10%, then it will be taxable. That is, inadequate consideration will be taxable in the hands of buyer. Got it? So this is a connection with respect to three different heads from two different parties angle with respect to land, building, or both, guys. Got it? Yes, sir. Fine. Let me go back. So I have explained all this provision. I have also given you, which is whatever I explained through a chart, guys. Yes. Exception is. So irrespective of the value of the gift received, if the gift is received from relative or on the occasion of marriage from anyone or under a will or by way of inheritance, then it is not taxable, guys. Irrespective of the value. Got it? Yes. There are few more cases, but the most important cases I have highlighted here. Got it? Yes. And please be careful, especially movable property and immobile property is taxable as per section 56 to 10 only if it is capital asset in the hands of recipient. If it is a stock or inventory, obviously, guys, they are dealing with it. They will buy it at lower price and sell it at higher price. Now, Income Tax Act cannot come and tell, hey, you pay tax on the inadequate consideration. Correct? No, that won't be fair. So please be careful for this two asset. Gift taxation under section 56 to 10 will be applicable only if it is in the nature of capital asset for the recipient. Got it? Yes, sir. Fine. Done with this. So with respect to clubbing, I already explained it. Even this I already covered. Then taxation of dividends I already covered. Okay. Coming to the deductions. Guys, if assessee has incurred any expenses to earn an income which is taxable under the head other sources, he can claim such expenses. But if he has incurred any expenses to earn casual income, he cannot claim it. If he has incurred any expenses to earn the buyback price, correct? That is the buyback price which is paid by domestic company. Against that, assessee cannot claim any expenses. Okay. There are few more expenses which are not allowed under section 58 while computing the income under the head income from other sources. Which are those? And most of them is connected to PGBP also. But under PGBP, it is covered under the different sections, whereas under the head other sources, it is covered in one single section, that is 58. But please be careful, don't get confused. Don't get confused. Whatever we are learning here, is the expenses which are not allowed while computing income from other sources. Whereas whatever we have already learned under the head PGBP is the expenses which are disallowed while computing PGBP income, that is income from business or profession. But some similarities is there. Okay, one by one. First one. Any personal expenses of the assessee? Yes, it is covered in section 37 in PGBP. Yes. Next, any interest which is payable outside India on which TDS has not been paid or deducted? Yes. Then, any payment chargeable to tax under the head salaries. And if it is payable outside India without deducting TDS, it is not allowed. Okay. Then, if any payment is made to a resident, on which TDS is not deducted or is deducted but not remitted within the due date of filing the returns, then 30% of such expenditure will be disallowed. Okay. Then, any expenditure in respect of which a payment is made to a related person to the extent the same is considered as excessive or unreasonable, that is excessive payment made to relatives or associated concern, will be disallowed, only the excess part. Then if any cash payment is made to a single person in a single day more than 10,000, the entire amount would be disallowed. Okay. Then the last one, no deduction in respect of any expenditure incurred in connection with casual income. And please be careful, I am repeating once again, under the head other sources, all these are covered in section 58. And if you want me to tell, sir, under PGBP, where is it covered? This is covered under section 37. Okay, let me write. Okay. This is covered under section 37. Okay. Interest payable outside India, this is under section 40A. One second, 40A1. Okay, then salary payable outside India under section 40A3. Then payment made to a resident, this is 40A1A. 1 second, 40A space is not ever 40A 1A. Okay. Then any expenditure which is unreasonable and all is covered under section 40A2 in PGBP head. Then cash payment more than 10,000 is covered under section 40A3. Easy to remember. Guys, cash payment more than 10,000 to a single person in a single day is disallowed fully. Is given in section 40A3 in PGBP. And you know 3. Cash. It start with the word cash. C is the third alphabet. So A3. A3. Try to remember like that. Okay, sir. Done. Let us move forward. Section 59 will specify if assessee has claimed any expenses or loss in the past while computing the income under the head other sources, and if we recover that in the current year, whatever amount is recovering it will be taxable under the head income from other sources in the year in which it is recovered. It is very similar to section 41(1), which we have covered in PGBP head, guys. Deemed profit. But that was under the head PGBP, whereas here under section 59, it is income from other sources. Then there are list of incomes which are exempt under the income tax law. What are those? I have given you. Section 1015 gives exemption for interest income. Income by way of interest or premium on redemption or other payments on securities and gold deposit bonds issued by central government shall be exempt. Then this is important. Interest on post office savings bank account is exempt to the extent of 3,500 maximum in case of individual account. If it is a joint account, it is 7,000 maximum. If interest itself is less than that, then you can claim only that much exemption. For example, I earned only 2,000 interest, claim only 2,000 exemption. Sir, what if I earned 20,000 interest? Then only 3,500 can be claimed as an exemption. But please be careful, for this exemption, deduction is available under section 80 TTA and TTB. We will learn that in deductions chapter. So if assessee has interest from savings deposit in post office, he can claim exemption under section 1015 as well as deduction under section 80 TTA or TTP. Okay, sir. Next, 1016. If a scholarship is received to meet the cost of education, whoever has given it, doesn't matter. For the receiver, it is exempt as per section 10 clause 16, guys. Then 1017. Guys, you should know that there is no employer-employee relationship between the government and MP MLAs. They are just representing the constituency from where they are elected. So whatever salary, including allowance and perquisite they are earning from the government, will be taxable under the head other sources and not under the head salary. But whatever daily allowance, constituency allowance, which is earned by MP and MLA is fully exempt. But if that MP or MLA is following the default scheme under section 115 BAC, then this exemption is not available for them. means daily allowance and constituency allowance will be taxable for them. Okay. Then section 1018 and 1019 gives exemption for family pension and all. What is it? We will see. Not for everyone. If I was an employee of state government or central government, and if I am receiving pension after receiving any of this award, after receiving any of this award, if I am alive and whatever pension I am receiving is exempt. Now, if by chance, if I have died and if my family members are receiving family pension, even that is exempt under section 1018. I repeat, assume I was an employee of state government or central government and I was awarded with any of these awards. And if I am alive and if I am receiving pension after my retirement, in that case, whatever pension I am receiving from the government will be fully exempt. If in case, if I die and if my family members are receiving the family pension, even that is exempt under section 1018. Okay. Then 1019 is if a person is working in Indian Army and if they have died during the operational duties, that is during any enemy attack, in case of that, if a nominee or family member of that person is receiving a family pension, it is fully exempt under section 10 clause 19, guys. 10 clause 19. Did you guys get it? Yes, guys. So this is all about the income from other sources in the question bank, guys, especially with respect to gift taxation. You guys solve this question without fail. Question number 2, where I have given the list of transactions. You need to identify whether it is taxable or not. If yes, how much? Other questions also you go through, which is easy, but this is very important because gift taxation can be tested, guys. Got it? Yes, sir. So we are done with income from other sources. So we will just mark the section whichever we have covered till now in this head. So all the heads of income is done, guys. So we covered now section 56 to 59, guys. So please make sure that whatever is done till now, you guys are thorough with these provisions. If by chance, if you guys have any confusion or anything, please go back to that video and watch it again. And you guys proceed further only once you are conceptually strong with whatever we already done, guys. And you can do it. All the best.